Hello and welcome back to Money Talks, the podcast that makes sense of the dollars and cents in your world. I'm your host, Rita. Last week, we had a fantastic discussion on fundamental and technical analysis that really resonated with you all, and we can't thank you enough for the feedback. For more insights, don't forget to like and subscribe on Spotify, Apple Podcasts, YouTube, Amazon Music, or wherever you get your podcasts. Today, we're drilling down from the big picture to the nitty-gritty. We're talking company analysis. And to help us unpack this crucial topic, we're thrilled to have financial professional Veeral Kotak back on the show. Hey Veeral, welcome back. How's everything going?
Hey Rita, it's great to be back. Things are going well, thanks. It's a busy time in the financial world, that's for sure.
It definitely seems that way. Before we dive into company analysis, there's some big news in the financial education sphere that's got everyone talking. Fitch Learning is acquiring the Canadian Securities Institute, or CSI. Can you talk about the importance of this and maybe give a wandering opinion about how this might affect candidates for the new CIRO exams and the Canadian banking industry?
Absolutely, it's a significant shift. For decades, the CSI has been the cornerstone of proficiency for Canadian financial professionals. Now, with Fitch Learning, a global player, taking over, we're likely to see some big changes. Fitch was already partnered with the new regulatory body, CIRO, to develop the new proficiency models starting in 2026, so this acquisition solidifies their position. For the candidates studying for the new CIRO exams, this could mean a more global perspective integrated into their learning, different course materials, and maybe a different exam interface. It creates some uncertainty in the short term, but the hope is that it brings fresh investment and a modernized approach to financial education in Canada. For the banking industry, it means the people they hire will be trained under a new framework. Banks will be watching closely to see how the quality and focus of the education evolves, as it directly impacts the capabilities of their new advisors and analysts. It's a major shakeup, and everyone's waiting to see how the dust settles.
Wow, that's a great breakdown. It really puts the industry changes into perspective. And that actually brings us perfectly to our main topic. For those who are just starting their investment journey, can you explain to me and our audiences what company analysis is all about?
Of course. Think of it like this. If macroeconomic analysis is checking the weather forecast for your road trip, and industry analysis is checking the traffic on the highway you'll be on, then company analysis is inspecting the actual car you're going to drive. It's the process of looking under the hood of a specific company to see if it's a sound investment. You're asking questions like, is this company financially healthy? Is it making good use of its resources? And are its shares a good buy right now?
I love that analogy. So where does an analyst start? What's the first thing they look at when they pop the hood?
You start with the company's financial statements. These are the official report cards. The two big ones are the Statement of Comprehensive Income, which is like a highlight reel of the company's performance over a period, showing revenues and costs, and the Statement of Financial Position, which is a snapshot in time of what the company owns and what it owes.
Okay, so let's talk about that highlight reel. The income statement. What are the key things to look for?
First, you look at revenue. Is it growing, flat, declining? But more importantly, why is it growing? Is it because they're selling more products, like Lululemon opening new stores and gaining market share? Or did they just acquire another company? Then you look at costs. If revenue is going up by 10%, but their costs are going up by 20%, that's a red flag. It might mean they're having trouble managing expenses, and that eats away at potential profit. Another key area is the dividend record. Does the company share its profits with shareholders? A stable dividend is often a sign of a mature, healthy company. Think of a big Canadian bank like RBC or TD. They have a long history of paying dividends.
That makes sense. What about the other report card, the Statement of Financial Position?
This statement tells you about the company's capital structure, basically how much of its operations are funded by debt versus money from shareholders, which is called equity. A company with a lot of debt is what we call leveraged. Leverage can be a powerful tool. It can magnify profits when things are good, but it's a double-edged sword. When the economy slows down, that debt becomes a heavy anchor, and earnings can collapse much faster than for a company with no debt. It's a measure of risk.
So once you have these statements, you can't just take them at face value, right? How do you make sense of all those numbers?
Exactly. This is where financial ratios come in. Ratios are the tools that help you test the company's health. They turn raw numbers into meaningful insights. We generally group them into 4 types: liquidity, risk analysis, operating performance, and value ratios.
Let's break those down. What do liquidity ratios tell us?
Liquidity ratios tell you if a company can pay its short-term bills. The most common one is the current ratio, which compares current assets to current liabilities. Imagine you're looking at Canadian Tire. They have a lot of assets in inventory, all those tools, tents, and hockey sticks. This ratio helps you understand if they have enough cash or things they can quickly turn into cash to cover their immediate debts.
And risk analysis ratios?
These dig deeper into that debt we talked about. A key one is the debt-to-equity ratio. It shows how much the company is relying on borrowing versus using shareholders' money, which is equity. A high ratio might be normal for a utility company like Fortis, which has very stable, predictable income. But for a retailer in a competitive market, a high debt load could be a sign of trouble. It's a measure of risk.
Okay, what about operating performance?
This is about efficiency. How good is management at turning revenue into actual profit? We look at the net profit margin. For every dollar in sales, how many cents are left over as profit after all expenses and taxes have been paid? A company like Dollarama, for example, operates on thin margins, but massive volume. Their efficiency is key to their success. You want to see that margin being stable, or even better, improving over time.
And finally, value ratios. I feel like this is the one most investors are interested in.
It is, because it connects the company's financial performance to its stock price in the market. The most famous one is the price to earnings, or PE ratio. It tells you how much investors are willing to pay for every dollar of the company's earnings. For example, a tech company like Shopify might have a very high PE ratio because investors expect fast future growth. A more established company might have a lower PE ratio. It's a quick way to gauge market sentiment and see if a stock is cheap or expensive compared to its peers.
This is so helpful, Veeral. It really feels like you're giving our listeners a toolkit to start their own analysis. As we wrap up, what's a key reflective question our audience should ask themselves when they think about investing in a company?
I think the big question to ask is, do I understand the story the numbers are telling? Company analysis isn't just about crunching numbers. It's about interpreting them to understand the health, risk, and potential of a business. Each ratio is a clue. When you put them all together, you get a story. Your job as an investor is to see if you believe in that story for the long run.
The story the numbers are telling. I love that. Veeral, thank you so much for breaking down such a complex topic into clear, actionable insights for us today.
My pleasure, Rita. Always happy to be here.
That's all the time we have for this episode of Money Talks. A huge thank you to our guest, Veeral Kotak. Join us next week as we continue our journey through the world of finance. Until then, stay curious and invest wisely.